We have just received new information, new data, new signals that suggest that something sinister is happening underneath the hood of the US economy. But this also lays the groundwork for a future Fed pivot coming later this year. And that's exactly what we're going to be talking about in today's video. Look at this. The Fed, they're opting for a hike and see in a gamble that the crisis will stay contained. Jerome and his team, they're essentially saying that they don't expect rates to be cut later this year, but the yield curve begs to differ. I've got two graphs on the screen for you. One is the yield curve of today, and the other is the yield curve 30 days ago. And we can see that between the maturities of the 5-year and the 10-year bonds, the yields are starting to flatten out. Now, why might this be important, you think? Well, this is because a flattening yield curve indicates that investors expect rate hikes in the near term, but they've lost confidence in the economic growth outlook. And that eventually means that rates will be cut. Now, before we continue, make sure to follow my strategy and my investment research on Substack. Follow my friends on the network who I recommend as well. Links in the description below. My friends, the fierce debate on the future of rates and inflation continues. You can see here that the Fed is in a really difficult spot. If they become more hawkish, they risk breaking the system. If they get into dovish mode, they risk sparking a risk-on rally and a decline in yields that will later spur back on inflation. In other words, the Fed, they're trapped and they're cornered. Now, the Fed also wants to hold on to the higher for longer narrative unless there's greater chaos in the system. That way they can slay inflation. But once chaos ensues, they're going to be forced to cut rates, and that's when Armageddon will really begin. You can see here that the Fed recently said that they're going to make a shift from ongoing increases to additional policy firming. My opinion of that means that they want to hold rates here until something breaks, and they're going to do whatever they can to hold it here, but danger down the road will force them to change their path. We can see here another opinion from the legend himself, Michael Burry. He's saying that in 2000, 2008, 2023, it's always the same. People full of hubris and greed taking stupid risks, and then they fail. Money is then printed because it works so well. We're also seeing that credit card debt is at an all-time high, putting households near a breaking point. And despite the Fed raising rates, mortgage rates were unable to surpass past 7% because the economic uncertainty is getting greater and greater. We have more Americans that are using buy now, pay later services to pay for everyday things like groceries. This is important because before, buy now, pay later was used to spread bigger bills on high-ticket items, expensive items. Now it's being used to pay for groceries. Now, we can see that my affluent audience on YouTube, you guys, even you guys are especially cautious on career prospects. Look at this. Only 42% of my friends on YouTube feel confident about their career prospects. I believe that my audience is relatively well educated and affluent. So if you guys feel uncertain, just think about how the rest of the world must feel. Let's take a look at the key people and their involvement and their views in this banking crisis. Warren Buffett, he's been in contact with Biden officials on banking crisis as U.S. small lenders seek wider deposit guarantee. You may remember that Buffett has a history of stepping into banking crises, and he's helped Goldman Sachs and Bank of America in the past get out of trouble. We're also seeing hedge fund manager Bill Ackman warning about an accelerated deposit outflow after the Fed decision. Now, to explain what he means, Ackman is essentially saying that with a lot of banks essentially yielding 0%, well, a lot of people are going to yank their funds from those banks and into high yield savings accounts or money markets that actually pay 4 or 5%, and that could cause additional bank runs. And because of the dynamic happening in the banking system right now, we're seeing Ray Dalio warning that SVB's collapse is showing that cracks are widening in global finance. Specifically, he's saying that this bank's failure is a canary in the coal mine and that it's an early sign dynamic that will have knock-on effects in the venture world and very well beyond it. He goes on to say that it is likely that this bank failure will be followed by many more problems before the contraction phase of the cycle runs its course, and we are approaching the turning point. Now, of course, the turning point will eventually set the stage for a Fed pivot later this year, so there will be better days ahead. We just need to survive until that moment comes. Now, not all hope is lost because today's sponsor is going to help you up-level your skills. Now there, are you ready to take your investment strategy journey to the next level? Because if you are, today's video partner, Brilliant.org, can help you do just that. Whether you're a seasoned investor or just starting out, leveling up your skills and knowledge is key to success. If you're looking to get more technical with finance, building on your math and computer science skills for advanced analysis and modeling is essential, and that's where Brilliant.org comes in. With their interactive and bite-sized lessons, you can quickly acquire and perfect the necessary skills to understand analysis and models to an even greater extent. The probabilities course, for example, teaches the fundamentals of chance, including calculating probabilities of events and understanding different types of probability distributions. When it comes to finance and investing, understanding probability is crucial. Investors need to be able to calculate the likelihood of different outcomes and make decisions based on those probabilities. But it's not just finance-related courses that Brilliant offers. They also have courses in data science and software development, which can help you advance your investment strategy even further. With thousands of lessons available from foundational to advanced math to data science, you can learn interactively and at your own pace. And the best part, you can try everything Brilliant has to offer for free for a full 30 days by visiting brilliant.org/Larry Chung or clicking on the link in the description below. Plus, the first 200 of you to sign up will get an additional 20% off Brilliant's annual premium subscription. So whether you're looking to level up your finance skills or learn something completely different, Brilliant.org is the perfect supplement to your investment strategy journey. Visit their website today and start learning. Now, back to the video. We can see here that Amazon, they're cutting 9,000 more jobs. Accenture, they're cutting 19,000 jobs with the biggest pullback in consulting. And all of these white-collar jobs being laid off is going to add additional stress into the commercial real estate market that's already having a lot of significant problems. But there's also good news that I wish to share with you. Look here, China's surprise RRR cut puts focus on bank lending rates. And this surprise cut is going to shore up confidence in the real estate market in China. We can see here that China's real estate is showing signs of recovery after the slump. If we take a look at this chart, we can see that housing demand is showing signs of stabilization. China's home sales posted the first increase by value since June 2021. That's good news. Now, this RRR cut, which will take effect from March 27th, caught many analysts off guard as it wasn't telegraphed by the State Council, China's cabinet, ahead of time. But that's usually how it works when it comes to monetary policy in China. Now, the knock-on effects of policy stimulus in China is helping big tech in the Chinese internet sector stage a rebound. Look here, Tencent is returning to revenue growth with a digital ad recovery. And Baidu is soaring after analysts gave earnings a thumbs up after the test run. I recently talked about this in a video when I discussed the Chinese internet sector possibly staging a rebound later this year. Now I want to take a moment to talk about what we've been doing inside our community. Now we know a lot of strategists on YouTube, on Twitter, on Substack, their primary strategy has been to tell people, go hide out in cash. Go put all your money in cash. It's yielding 4%. Not a bad strategy. I definitely align with that. However, I'm being extra proactive. Whenever there are mispricings in the market, I'm actively finding opportunity for our good people inside Substack and on Patreon. Examples include the banking crisis. Other examples include China. Take a look at what we discussed relating to China. So as you know, Baidu's Ernie AI bot, the competitor to ChatGPT, they recently came out with their launch, and that's been very supportive for the shares. I've also talked about how Alibaba was great value, at least to me, between the range of $75 to $80. I talked about how Tesla, while it was trading at 45 times forward earnings at $180 per share, still included some short-term upside, and how Google at $92 a share represented good value in my opinion. As we can see here, there still is a lot of geopolitical risk for China, so you do have to be very careful. Look here, Xi Jinping and Putin, their meeting raises risks of more US sanctions. But at the end of the day, I believe that there was tactical opportunity in China, that there was tactical opportunity in the banking sector. And when you take it one day at a time, slowly but surely, you can find ideas that can add on to your 4% cash position. So overall, prioritizing thoughtful, careful construction over greedy execution, that's what we've been doing. So make sure to follow me at Larry Chung CFA for thought leadership on Twitter. I really do believe this. For many, many, many people, the worst has yet to come. But for you and me, the best is only beginning, okay? So if we look here, a lot of our friends on YouTube, they're thinking that the terminal Fed funds rates are going to be well above 5%, and only 11% of people think that Fed funds rates will come down under 5% by the end of the year. To be honest, with all the economic Armageddon that's happening in the environment, I think that it's possible that an under 5% terminal rate could be achieved later this year. We've got 9 months to go, a lot of uncertainty. I think the Fed is too confident that they can keep rates at this elevated level, but we will see. More commentary on markets and life perspectives on Instagram. Make sure to follow my strategy and research on Substack. And with that said, thank you to Brilliant.org for sponsoring today's video, and I will see you guys in my next video.